Oh God, I have to tell you, this was such a fun interview. Welcome back to Zang Enterprises. I mean, I had the honor and so much fun interviewing Rick Rule today. He has spent more than 5 decades in the precious metals and natural resources markets. He's navigated inflation, deflation. He was there in the 70s like I was as we shifted from at least a quasi-gold-backed system into a pure debt-based system. But you know what I like the best? Honest to goodness, and this is going to seem so weird, is we had such a deep conversation about derivatives. Now, you guys know me, and you know that I bring that up regularly, but this was really the first time that I had an opportunity to talk to somebody this brilliant on that topic. So I want you to watch this more than once, and you'll hear me say that in the interview. But seriously, I think I loved this interview, and I think you will too. So the first question that I really want, you've been around for a very long time, very well respected, and I really appreciate you being here. But I have to ask you, you've lived through a lot of financial cycles. Does this one seem similar to ones you've had in the past, or how might this be different?
If you give me the use of the word similar, then
Well,
yes. Uh,
okay,
it, it
similar
reminds it
chaos.
reminds me the most of the 1970s
Yes.
in the sense that we're coming off 20 or 30 years of fairly benign economic climate. I'm not suggesting, by the way, that World War II was benign, but the post-World War II period from 1945 uh, to 1970 was really fairly benign. U.S. dollar hegemony, declining interest rates, strong economic growth. And underlying that was an investment focus on industries that were non-extractive. The growth of the United States is an example.
Mhm.
So the Nifty 50 is an example in the 60s attracted a lot of investment attention. There was not a lot of investment attention paid to underlying materials. Well, the use of those underlying materials was growing. There was a coiled spring aspect to it. At the same time, the economic climate in the late 40s and the 50s, in fact, most of the 60s, was so benign that people forgot to be afraid. They forgot to understand what was happening to the federal budget, what was happening to tax rates, uh, what was happening to underlying wage and cost explosion. And that all came to a head in 1970. I think that's very similar to the
Mhm.
circumstance that we face today, Lynette. If you look back at the period 1982 to 2022, uh, I suspect that when history is written, that will be the most benign investing epoch in human history.
It's kind of interesting that you say that, and then also, like you said that they weren't really paying attention to the underlying materials. Are you talking about like commodities like
Yes,
lumber and
yes, absolutely. Absolutely. Our society had been underinvesting in productive capacity around raw materials literally since the Depression. We used a ton in World War II,
mhm,
came
mhm.
out of World War II unconstrained. We were more worried about a depression or a recession than we were about economic growth. And the consequence of that is that we underinvested in productive capacity, even as we were using up our developed resources. Very
Interesting.
similar to
It,
today.
well, you also I agree with you 100%, and there were things that are happening then and things that are happening now, but the other thing was a lot of distraction in the 70s and the 60s and the 70s. So was it the distraction that you think maybe caught? I mean, I can't even say because I was there. I was born in 54.
Yep.
So I remember that period, really well, and the Vietnam War and all of the I mean, there was chaos, the women's lib movement, civil rights movement, oil embargo.
I'm less active, less, pardon me, less capable of commenting on the sort of zeitgeist, the sociology.
Ah,
Uh, I don't know how to dress myself. I don't own a TV. So in terms of all that, I'll rely on you to fill in the blanks of my testimony.
Hmm.
Uh, I can just say that we underinvested in productive capacity at the same time that demand increased, and we ignored the increase in underlying supplies. The the place where this market maybe resembles a different bull market in commodities has to do with the market that we experienced 2000 to 2010. And there, I think the wild card really was the urbanization of China, the realization of Deng Xiaoping's statement to become rich is glorious. I say we because it's a triumph for humankind. We incorporated 500 million impoverished rural Chinese into middle class existence.
Hmm.
And we generated a tremendous demand for resources, competition from a people who hadn't competed with us before because they were too poor. Uh, we have done, I think, as a species, a tremendous job in the last 40 years of raising the poorest of the poor from being desperately poor to being merely poor. Uh, and it's my belief that we finish the job in the next 20 or 25 years. There are a billion people on Earth who have no access to primary electricity. And I think they're going to get it in the next 20 years. That's going to generate tremendous demand for energy of all sources, but tremendous demand too for things like copper and all of the things that go into enabling people to enjoy the life that you and I live. So I think the 10 years that are in front of us incorporates the circumstance that confronted us in the 70s, persistently high inflation,
Hmm.
but also increasing demand for commodities in the face of declining supplies of commodities. And that gets exacerbated by the introduction of a billion uh, extraordinarily poor consumers coming into the market and becoming increasingly wealthier. Um, a pretty interesting circumstance, one fraught with risk, of course. Inflation is a bad
Hmm.
circumstance in anybody's mind. And the people in the West who aren't prepared to deal with a billion new competitors for the stuff of life will not like the diminution in their living standards that comes from having to compete with a billion people. But making a billion people less poor is a good thing.
Well, I do agree with that. Um, although like the 70s, we are transitioning into a different, well, I don't brand new, but a different monetary system. Do you think
You are
that's going
correct.
to go super easy, or,
No,
what
I
do
think
you
it's
see there? Because that's the
I
same thing.
I think it's going to be a mess, Lynette. I mean, a mess. I don't know how we deal with it because, again, I don't own a TV. I can just give you the arithmetic of the problem. In this country, which I still maintain is the most dynamic culture on the planet, but in this country, hold on, let me second, let me kill this. In this country, the numbers around our money are staggeringly bad.
Yes.
The on balance sheet liabilities of the US government are at 38, almost $39 trillion. When people hear a trillion, their eyes glaze over,
Hmm. Hmm.
but it's a real number. Much more challenging to me is, and I'd be interested in your listeners' response, the off balance sheet liabilities.
Yes.
According to the Congressional Budget Office, the net present value of unfunded entitlement promises, net present value, not the nominal value, exceeds $120 trillion. Now you add those two numbers together, 39 trillion and 120 trillion, you get a fairly ugly number, 159 trillion. That number is relevant when you put it in the context of the Internal Revenue Service estimate of the private net worth of all Americans combined,
Hmm.
which is $167 trillion. We're worth 167 and we owe 159 at the federal level alone. It gets worse, of course. The off-balance sheet liabilities of the U.S. government are estimated by the Congressional Budget Office to be increasing at between $2 and $3 trillion a year,
Hmm.
and the on-balance sheet liabilities are increasing by about $2 trillion
Hmm.
a year. I mean, something's got to give. The math don't math.
No.
Now, what we could do is we could do what the Argentines used to do. We could have an honest default. We could say to the bondholders, "Too bad, so sad, no money, strong letter to follow." And we could say to old folks like you and me, "Yeah, we know you paid into Social Security for 60 years, but there's no dough left, so you aren't getting any." That would be the honest thing to do, but that's not the American way.
True.
What I think we do is we honor the nominal value of our obligations and we inflate away the net present value of our obligations,
Yep.
which is what we did in the 70s. We didn't index taxation to an accurate measure of inflation. Yeah, you got it. You got it. In the decade of the 70s, Lynette, and you've probably already discussed this with your listeners, in the decade of the 70s, according to the Office of Management and Budget, not some cranky old libertarian, the US dollar lost 75% of its purchasing power. We did this before.
Yes.
Not coincidentally, the gold price went up, what, 26, 27 fold?
Hmm.
This isn't to suggest that the gold price goes up 26 fold from here, by the way. But I would suggest to you that it will take a 75% devaluation in the purchasing power of the dollar to make our nominal obligation serviceable. You'll get through it fine. You add value. I'll get through it fine. I add value. A pensioner on a fixed income
Yeah.
who is spending $4,000 a month today needs to know that he or she will need to make $16,000 a month 10 years from now to sustain the same standard of living that $4,000 sustains today. And that's a truly ugly number.
Yeah. Well, there's something else that, and I hadn't really ever thought of it this way. So, this is a reasonably new thought process that I was going through because, of course, being American, you don't really want to think that our government would do an overt confiscation, certainly of our wealth. And they certainly have in this country many times. But the last time was 1971 when Nixon defaulted on Bretton
Right.
Woods. So all of those governments whose gold that we were holding with the promise to convert the dollars into them and they could take it back, nobody ever says that's a confiscation, but every country has a gold revaluation account. The US is not alone in the unpayable level of debt or promises. And there's no way to even know unless you might have a way, but I haven't figured out how to know how many derivatives are against all of this stuff and what's really happening in that market after 15 years of ZERP. But I'm convinced, and you say however you think anyway, you're going to anyway, which you should. But I think that we're transitioning into a brand new system and that these transitions like the 70s are not easy for most people. What are your thoughts? Will we end up in a confiscation more overt? Because price manipulation is a confiscation, taxation, inflation, all of that is a form of confiscation.
Uh, the most honest answer is I don't know. Uh, the more nuanced answer is that if politicians steal from you and I overtly, there are costs to them. Uh,
Really?
yeah, I think
I'm
there are.
sorry, Rick. I haven't seen too many of those costs. But go
Well,
ahead.
there are prospective costs.
Yeah.
If they came and said, "We are only gonna let your IRA invest in government securities," I think they would become acquainted with the fact that there were 400 million guns in private circulation in the US. If they came to steal your gold again, I think there would be real political costs. If, however, they persist with deficit spending, if they persist with inflation, if they persist with artificially low interest rates, which subsidize spenders at the expense of savers, there are more spenders than savers in society, and they get rewarded for that same material.
Mm-hmm.
Uh, they get rewarded for those policies of wholesale theft, and they get punished for retail theft. If you assume that people seek rewards and they minimize risk, then Congress people, understanding that they're extremely popular and they get reelected, if they inflate, if they spend, if they steal from one small set of constituents called savers
Mm-hmm.
to benefit a very large constituent called spenders, they do well. And it seems to me that the course of least resistance, until it doesn't work anymore, is the status quo. Now, you mentioned earlier in the discussion a wild card, which is derivatives.
Mm-hmm.
You may know I've been in the banking business on and off for 45 years of my life, and I built a reasonably large brokerage firm. And I tried really hard to understand the risks presented to myself, my organization, my customers from derivatives. And I came to the unflattering conclusion after 40 years of study that I couldn't understand derivatives. I
Yep.
My avocation, proof that I'm a boring boy, is that I try to analyze the balance sheets of very complex financial institutions, JP Morgan Chase, Goldman Sachs. While other people watch the Super Bowl, that's what I do. And I can't understand those balance sheets. And I'm good at balance sheets.
Mm-hmm.
I had a discussion with the then treasurer of Goldman Sachs some years ago. And I said, explain to me how the equity slice that you have in Goldman Sachs uh, can intermediate a $60 trillion derivative liability. And he said, well, you're talking about the notional liability. That liability is hedged one against the other, in effect, 30 long, 30 short. We're the guarantor on both sides. I said, yeah, what about if somebody doesn't pay? You know, I mean,
That's called counterparty risk.
yeah, I mean, what level of capital is required to balance or intermediate, guarantee what level of derivative liability? The upshot of that is when I was looking for a clearing firm for my broker dealer, I looked at 13 clearing firms, no, 16 clearing firms, doesn't matter, some large number of clearing firms. And in the end, uh, rather than focusing merely on the level of services or the price for those services, I settled on balance sheet stability. I went for a clearing firm that had the lowest of liability relative to their capital base. And I would suspect, Lynette, that not one of 1,000 of your listeners reviews their banking or brokerage relationships the same way.
Mm-hmm.
That leads me to think that the possibility of a 2008 style
Mm-hmm.
liquidity event, which is very different than necessarily the outcome of inflation, but
Yes.
a very fast moving liquidity event, is a risk that's really understated because I don't think it's in people's minds. When I look at the way people act, when I look at the way people open brokerage accounts or insure themselves or bank without any reflection on the underlying derivative liability, it tells me that the possibility of a scare associated with that is very, very high. I'm not an economist, so I can't quantify it, but I do study the way people invest. And the way people invest does not pay as much attention as it should to the stability of the organizations that investors trust their money with.
Well, frankly, you brought up a really important point, one that I've struggled with but understood for a really long time when it comes to derivatives. And anybody that's watching, if you're around in 2008, I mean, it was happening before then, but the public became aware of it in the subprime when they dried up in 24 hours. So even if you were slated to close on your house that next morning, it was not happening. Go back and look. And that was the second big derivative explosion after long-term capital management. But the point that you brought up is you're brilliant. You've studied this for 45 years. You've had to balance everything and you don't understand them. And my concern is that the people that create them and manage them, they don't understand them either. Because I've read some of their documentation where they actually said, and it was before I understood print screen and I haven't been able to find it, but they said, if we make this really complicated, nobody will question us. And that's true with money in general, right? People are, well, I don't understand it, so they must understand it. And I think that's why they don't question it. But do you think that a derivative implosion, because we can't even see it, it's the guys that make this mess, that own everything, Seed and Company, all the JP Morgans and Goldman Sachs, that create this mess, can determine whether or not there is a default on it, but we can't even see it. Can we?
I think 2008, we saw the product of it.
Mm-hmm.
And I will say, I was in my own way guilty, not of creating this product, but not seeing it. I remember very well to this day, driving north on the 405 freeway in Los Angeles toward LAX. And on the east side of the freeway, the right side as you drive north, I saw a great big billboard. It said, borrow 125% of the value of your home, bad credit, okay. I was not a real estate lender, but I remember thinking, because I am a lender, I wonder how this works out for them. Well, ironically, that billboard was paid for by Ditech, which was the mortgage subsidiary of General Motors, which went broke. But the idea that I, who's lived in financial services my whole life,
Mm-hmm.
take that in late 2006 as an indicator and reorganize my own portfolio more substantially is, I think, a reflection of just how guilty our society is at taking responsibility for their own
Yeah.
future.
Yeah.
If you look at the consolidated balance sheets of the equity component of the balance sheets of the big financial services firms in the US, relative to their aggregate notional derivative liability, um, I'm not saying it's going to blow up. What I am saying is that nobody knows if it's going to blow up. It's an unquantifiable risk that people aren't paying attention to. I am now.
Yes.
Uh,
Me
I
too.
have personally, since the year 2000, maintained liquidity in US dollars, but I've saved in gold. It,
Me
it, it
too.
turns out, it turns out accidentally that was a good idea. Uh, that isn't why I did it. I did it because if there was a blow up, I'd prefer not to play. You know,
Exactly. That is. And I like how you talk about people taking personal responsibilities, because that is all about the mantra. I think as we transition from the system that we're in now, which is barely limping along. I don't know if you agree with it or not, but in 2008, Shearson was my alma mater. That's where I was a
right,
stockbroker. So I
right,
was really paying very close attention to that. And it was those two Bear Stearns. Actually, there were three things that happened for me, right? Number
right,
one, it was July of 2007, when the US dollar index fell to the lowest level ever against its trade weighted basket. And I just went, oh, something nasty this way comes.
yeah,
I mean, I remember that very well. And then it was the Bear Stearns, those two funds. You always have to be careful how things are named because they're just the opposite, that went to nothing overnight. And that was that like March or April of 2007, February, something like that. So you could feel there was something in the air. I remember kind of being like freaked out. To be honest with you, I'm like, there is something very nasty that's coming this way. But
And
I
then
was
countrywide.
shocked when they let Lehman go out. I was
Yep.
shocked when they did that.
Right.
And
And then, of
then
course,
Lehman, they
blow
said, I'm sorry, go ahead.
or the blow up of countrywide, I think, is what brought it down to a household level off Wall
Yeah.
Street.
But it's like people don't see it until it's right in their face.
Right.
Do you think this time could be different than that? Because that's what I'm hoping.
Uh, I mean, the honest answer is, Lynette, I don't know, and I don't want to find out. I I sort of think that the complacency in our society at every level is dangerous.
Yes.
There are a lot of things now that are better than 2008. The bank balance sheets, although they're stretched by derivatives,
Are they?
if you X the derivatives, the bank balance sheets are much better than they were. Primary capital at JP Morgan Chase is in double digits, uh, despite the FDIC saying that a 7%, um, a 7% equity slice is sufficient capitalization. American banking has discovered that a higher number is probably better. I'll tell you what really scares me, and I don't want to make this whole interview doom and gloom because I think there's lots of bright things out there.
I do too,
The,
but let's talk about the doom and gloom for a minute.
the thing that scares me the most of anything are the high yield ETFs,
Mm-hmm.
ma and pa investors that are scrambling for yield in credits that they don't understand. These high yield ETFs have literally trillions of dollars in them, and they're extremely liquid. I mean, extremely
The
liquid.
moment.
The problem is that what they own is extremely illiquid. And if we came to a point in time where the ma and pa owners of these things began to express concern about credit and sell them, the managers of these funds, in order to fund these extremely liquid redemptions, have to sell extremely illiquid junk bonds. That's a run on the bank. Well, we had a saying when I was a young broker. I did a lot of high yield stuff in the old days, back when high yield was cheap. And we called an illiquid bond an owl bond. What that meant, Lynette, was when you called your broker to say sell, he or she would say, to who? To who?
I love that. I'm going to use that, Rick.
Please do. And the thing that really scares me among, aside from derivatives, I mean, the thing that scares me as being the pin that could pop the balloon
Mm-hmm. Mm-hmm.
is this proliferation of what should be private credit in public ETFs among people who own it simply for the yield without any understanding whatsoever of the credit risks that they're
Yes.
running.
So when you're talking high yield, because people hear that, would you define for our viewers what high yield is and also the level of leverage that has you concerned in these ETFs?
I think for the average investor, any debt that isn't investment grade, I mean, isn't triple B or better, uh, probably any debt that isn't investment grade, and also no, I wouldn't include publicly traded because I'm okay with prime rate bank loans. I'm okay with bank loans to, as an example, Exxon. That doesn't bother me.
Mm-hmm.
But the triple C's
Yeah.
to Schlepp, Schmuck, and Schmo Automotive or Red Lobster. uh, uh, People own these ETFs that are agglomerations of sub-investment grade credits. And those credits were established by Wall Street to benefit the issuer and generate a fee. They were not constructed for the benefit of the buyer. Uh, the buyers are, in very ugly parlance, yield whores. They chased 50 or 60 basis points or 100 basis points, and gave up completely any focus on credit quality.
Yep.
The second concern is, I think, duration. If you believe, like most of your listeners do, that inflation is expressed by the CPI, I think you need to reorganize your thinking. The CPI would have you believe that the underlying rate of deterioration of the purchasing power of the US dollar is 2.7%. Any of your listeners who use their common sense and compare a basket of goods and services that they acquired in 2020 against the price levels of that same basket of goods and services today will understand that that 2.6% is fallacious.
Hmm.
Besides which, the index, when it's inconvenient, doesn't include food or fuel. If you could see my total self, you would see that lunch is important to me. So that index is less relevant. And the index also doesn't include tax. Now, I would suggest, Lynette, and I think that your viewers, if they examined it, would agree that the real underlying rate of deterioration of the US dollar is more like 8%. That's where the problem is. If you are saving in a US 10-year treasury at 4.15 and you're getting paid back in a currency where the purchasing power is declining by 8, there's a negative yield.
Hmm.
Where that hits investors is that any long bond they own, any duration longer than 5 years, is exposing them to a negative real yield. And it exposes them to a capital loss if, as in the 1970s, capital markets come to understand that long bonds are destroyers of capital. So the people who are investing in these yield products with a sacrificing credit quality for yield and also assuming duration risk, which I think is underpriced, uh,
Yes.
really, really, really dangerous. They're really dangerous. And so often in public forums, when I'll discuss this, I'll be faced with a concerned couple that says, "But Mr. Rule, we need the yield," as though their own needs mattered somehow
Right.
in terms of the efficacy of what they were doing.
Right.
It's very unfortunate. I'm not gloating about this.
No, it is really unfortunate. And I'd also like to point out that in this environment where we were in ZERP for 15 years, the covenants, the protections for the investors, I mean,
They're
covenant
horrific.
light or no covenants, there's no protections for
Correct.
investors. And you brought up the private equity. Don't you think that's a great? I mean, there you brought up a lot of things, but you brought up the
Right.
private equity. Don't you think that should go into a 401k? And how about Alphabet's 100-year bond that was oversubscribed? I mean, I'm going to give you the floor.
A 100-year bond is, I don't know. It's a suggestion that there's fentanyl use on Wall Street. That's just,
That would not be a surprise.
that's that's in that's just, it's incredible to me. And by the way, I'm not overtly a doom and gloomer. I think that the world 20 years from now will be measurably better than it is today. I think we have to get from here to there.
That's it. Yes. And I agree with you. I mean, I'm not a pessimistic person. I'm extremely optimistic. And I do, like you, we see lots of opportunities. Um, but I'm also seeing that it's so critically important that we become as independent, self sufficient, and to your point, take responsibility for the choices that we make.
Right. One of the things I've learned building a new bank, naked commercial, is that there are $3 trillion in the US in bank deposits that pay no interest.
Hmm.
Now, why would you take deposit risk and get paid no interest? What are people thinking about when they deposit $3 trillion and don't receive interest? This is an increase in your sense of financial well being that isn't reliant on the state, it isn't reliant on your employer, it isn't reliant on your customer. All you have to do is switch from a no yield account to a yield account. And yet $3 trillion has forgotten to do this. When I talk to people, I don't know if you know this, Lynette, but I've offered free portfolio evaluations for 35 years, limited to natural resource stocks. I've graded almost 100,000 portfolios. And one of the things that strikes me is how little investors know about the companies that they've invested in.
Hmm.
Maybe the name, maybe the symbol. They certainly know day to day whether they're up or down. But the idea that you make money on the delta between what something is worth and what it sells for is foreign to most people. They pay slavish attention to the price information because it's easy to get, and they pay no attention to the value that's hard to get. That 100-year bond goes right to that. Why on earth would you, in an inflationary environment, I mean, this is what I guess it was Franz Pick used to describe as a certificate of guaranteed confiscation.
Yep.
Yep.
Well, it is because really the plan is to repay this debt with currency, fiat currency that has ultimately no value, which, by the way, is part of the strategy that we execute at Zang Enterprises. But
Right.
when I'm looking at this 100-year bond, and I'm thinking, why would anybody do it? And then it's oversubscribed.
Yeah.
It's really I know I do have to really think about this a lot. But did I hear you say that you just opened a new bank?
Yes.
Could you
Yes.
talk? I'm sure our viewers would really like to hear much more about that. And so what
I'd be
else?
delighted. People know me from natural resources,
Mhm.
but this is the seventh bank that I've had a real involvement in. The bank immediately before this was EverBank, which was a fairly popular bank. We were one of the first online banks in the US. Enjoyed real success by offering deposit products, particularly non-US dollar deposit products that Americans had never experienced before. And we grew that bank from 0 to 28B, then sold it to TIAA CREF.
Hmm.
TIAA CREF bought it because we had a great platform and they thought that they could introduce 1.5 million retired teachers to our platform and provide good banking services, which they did. But there was a big difference between the product aspirations of retired teachers and the product aspirations of the aspiring class who were our customers. And so our bank abandoned our customers after we sold it.
Hmm.
So rather than retire, I decided to join Frank Trotter and start a bank. By the way, a stupid thing to do if you intend to retire.
I
Uh,
did the same. I didn't start a bank, but yeah, at 69, I started
yeah, you get it.
Zang Enterprises. I get
So
it.
let's talk about what's different with our bank.
Yes.
Uh, First of all, although the regulators will tell you that 7% is well capitalized, I prefer some number like 10 or 11.
Mhm.
Although a lot of banks report profit trading in derivatives, I don't like unquantifiable risk. Will we hedge interest rates? In other words, will we use derivatives to enhance our balance as opposed to trade in them? Of course.
Mhm.
Will we trade or guarantee derivatives? Not on your life, not on my life. Deposits. Uh, we have, well, to differentiate us from our competitors, the big banks have 15 or 16 deposit products. The only reason that you would do that is to raise your costs or to confuse your customer. We
Right.
don't want to do either. We have one, a high yield money market account you can write checks against, you can do bill pay, and we pay you interest. It, it seems to me that people ought to be interested in receiving interest on their savings. The second thing that we'll do for depositors is we won't constrain you to just the US dollar. We will allow you access to FDIC insured deposit products in 20 currencies. And I believe that's going to come in handy. I believe the next 10 years will have plenty of currency volatility. But in particular, if you're a first generation business person and you live your life in Hong Kong dollars or US dollars or yen and US dollars or euros and US dollars, the ability to bank in both currencies will be important to you. The second feature about our bank that I think your listeners might like, Lynette, is that with Battle Bank, your IRA is actually your IRA. On Wall Street, your IRA is a receptacle for their annuities and ETFs and mutual funds. At Battle Bank, your IRA can own an owner-operated duplex or triplex, or an owner-operated Airbnb. You can own a Subway franchise. You can invest if you would like in private partnerships if you're accredited. You can do a whole bunch of things, and you decide. Wall Street doesn't decide. The third benefit of the bank, and this is what's really been responsible for the dramatic increase in interest in the bank, is that we believe that bullion is good collateral. No bank in the US will establish a credit line against physical gold, silver, platinum, or palladium in amounts less than $10 million. At Battle Bank, we believe, first of all, that people that save in gold and silver are prudent people. They're good people to lend to. But we also believe they're good collateral. And so at Battle Bank, you can, if you have gold, silver, platinum, or palladium in your portfolio, you can access that capital through a credit line. You don't even need to borrow the money. You have it available to you if you need it or want it without having to sell your bullion and pay the capital gains tax. I'm delighted to say, as a consequence of those three features, the deposit products, the bullion lending, and the IRA, that while we started Everbank with a zero customer backlog, when we roll out Battle Bank nationwide on February 17th, our customer backlog exceeds 20,000 people, which has
Do
been
20,001, would you, Rick?
well, I'm all over it, Lynette. We would love to bank you. We would love to bank you, dearly love to bank you. We will not be rolling out to the world on February 17th. We'll be rolling out to the wait list. So if you want to talk to us about those, please, please, please go to battlebank.com, get on the wait list, and tell us specifically what products or services on our menu you're interested in so that we don't make a solicitation to you that wastes your time.
So I do have a question, because you said that you can bank in different currencies, which is fabulous. And
Yep.
I've been doing a bit of work with the Nomad Capitalist, Andrew.
Right.
And so
Fantastic guy. Fantastic guy.
Oh,
Just a fantastic guy.
he really is. And
Yep.
his event, I was lucky enough to do that this
Right.
past year. And it was, I've done a lot of wonderful events.
Yep.
This is like right up at the tippy top. Phenomenal. But then you understand what my next question is. If for people that have bug out locations or multiple locations where they live, would your bank, would Battle Bank, be able to support that? How would that work? Or does it?
Initially, you will have to be a US citizen or a Canadian citizen. At Everbank, we were ultimately able to service customers in 28 countries. We need to get Battle Bank up and launched in the US before we worry about Australia, New Zealand, and Argentina. What we will be able to do that I think will be of interest to Ronan McMahon subscribers, to the Nomad Capitalist, is we will be able to provide US dollar first mortgages on properties in foreign countries that have title insurance.
Oh, I like that
So
one.
if you were to buy a residence at Rancho Santana, where I just was in Nicaragua, or in Cafayate in Argentina, places that are popular with American and Canadian expats,
Mhm.
and you wanted a US dollar first mortgage, provided that there's acceptable title insurance to us, we will provide first mortgage financing to Americans and Canadians on residential real estate domiciled outside of the US.
This is really excellent to know, because I did see a really nice piece of property in Panama. was perfect.
You just need to make sure that there's title insurance. We want to make sure that your property, Lynette, is actually your property, sometimes unbeknownst to you.
Oh, yeah. No, this is great. I'm really glad that we had an opportunity to talk about battle bank and especially derivatives because I pay a lot of attention to them. They are so complex and so complicated and so hidden,
Right.
and I mean, let's face it. When we were at zero interest rates for 15 years and there were all those derivatives that were written against that, and of course we know every single bank that bought all those bonds and mortgages and all that debt at zero. I mean, a run on the bank could definitely trigger something that they could not print their way out of.
Yep. And I think what's important for your listeners to understand is not merely that problem, but the fact that the problem's unquantifiable.
Yes.
Given the level of expertise that most people have, I can't understand it, and I've lived my whole life in finance. If I can't understand it, what's the probability that your listeners who have lives, jobs, homes, gardens, grandchildren, books, what's the probability that maybe they have the ability, but do they have the time and the inclination to understand it? Taking unquantifiable risks is not a smart thing to do.
Nope. And this is the time to get to safety. And I could go on and on and on. Honestly, this has been phenomenal. But is there anything that you would like to tell the viewers, something that they should pay attention to with your brilliant wisdom, which is so appreciated? Any last words that you'd like to leave them with?
First of all, don't come away from this interview thinking that things are hopeless, that what you're going to do is go in the corner, curl up in fetal position, and cry. If you don't prepare yourself, you're going to lose. And you don't have to lose. If you're prudent, you'll get through this. It won't be as easy as it's been in the past, but you and your family, and if you're lucky, your friends, will get through this in fairly fine order. How do you do that? Well, first of all, adjust your living standards to your financial standards. You need to save, and you need to save more than you think you're going to save because the purchasing power of your pension is going to decrease by 75% over 10 years.
If you're lucky.
Don't just save in dollars. I save in gold. And Lynette, I hope the gold price goes down. Yeah, I hope it goes down. I don't think it will, but I hope it does. For me, it's insurance. When you invest in things that you understand and understand that investment money, not speculative money, investment money is made on the delta between price and value or price and expected value. Most people's investment strategy is got a hunch, bet a bunch. They
Filled with hopium.
Yeah, right, right, and that's worked well for 40 years. It's about to work not so well. I'm not saying don't invest in NVIDIA. I'm saying if you invest in NVIDIA, know the chip business, know NVIDIA, know the competitors. Uh, I'm not saying don't invest in technology, although I don't. I'm saying invest in something that you understand well enough that you understand the juxtaposition between price and value. I would also say invest before you speculate. If I had a criticism of most investors, it's that they've ignored investment in favor of speculation. Now, I need to say that's what I did too. I got extremely lucky. All of the money that I now invest prudently, I made by speculating wildly. But I'm an outlier. I worked hard and I got lucky. Most people aren't willing. Yeah, most people aren't willing to work hard and they're not going to get lucky. So invest before you speculate. I, of course, am drawn to natural resources because I understand them. I'm drawn to oil and copper, the stuff of humankind, because I know that we've underinvested in it for 30 years. And I know that while demand is increasing, supplies are falling. And I know what happens when the laws of supply and demand intersect. the price response is dramatic. I'm
Yep.
also invested in precious metals because I don't understand the arithmetic of America. I don't understand how we deal with $160 trillion of liability at the federal level. And I think the past is prologue from the 70s. And so I would urge your listeners to uh, consider that too. Um, I hope. Oh, and of course, I would urge anybody who's invested in natural resources to submit their natural resource portfolio for me to grade. Go to ruleinvestmentmedia.com, list your natural resource stocks. Please, by the way, no crypto, no tech stocks, no pot stocks. Leave an old guy to do what he does well. Go to ruleinvestmentmedia.com. I will grade your natural resource portfolio for free, absolutely for free. Of course, that comes with a money back guarantee. It's a pretty good offer, and so I encourage people to do that. And I wouldn't. I guess that's all the commercials you need. Consider Battle Bank. Go to ruleinvestmentmedia.com. Um, Invest prudently, however unfun that might be. Save and consider the impact of what I call the arithmetic of America on your lifestyle over the next 10 years.
Wise words as always. We will have all of the links below. And, this has been phenomenal, Rick. I really appreciate it. And I also encourage anybody that's watching it, watch it more than once. There is so much wisdom in this video, and it's really, really important, especially when we're talking about derivatives. And I shouldn't tell you this, and then they might even edit this out. I don't know. But do you know what got me when I met my sweetheart? I talked to him about derivatives. He brought up the term derivatives. And as soon as he did that, I was like, cha-ching, somebody I could talk to. So I love that we really were able to dig into this. And I'd like to do it more because I think this is such an important issue. But I cannot thank you enough for being here today. This was phenomenal. I'm sorry it's taken so long. And I would like to do it again and again. And we're going to get on the wait list with Battle Bank, but I'm also we're going to talk to you about how we can really help our clients, because having the ability to borrow against your gold, don't max it out, but rather than liquidating and all of that, I can see that as part of the strategy. I can definitely see that.
Well, we look forward to that. And perhaps our next form of communication is that you should come speak at the Rural Natural Resources Investment Symposium in Boca Raton, Florida, July 6th through 12th.
I would be honored. I would be so honored. So
I think
if
you'd
you're
be
inviting me, I'm saying yes.
I think you'd be hugely amused by some of your fellow speakers, most of whom you will have met before. But the the symposium is actually a very good place. You know, Several thousand like-minded people. It's very pleasant. So we can visit offline about how we facilitate that. I'd love to have you down there. And as I say, I think our conference will resonate with your audience. I think you'll resonate with the conference audience. The conference has gone on for 30 years, so we've clearly done something right.
Oh yeah. Oh yes. And actually, I've wanted to do your conference, so I am very thrilled that you have invited me, and I will be there.
Great, great. So perhaps include a list, a link for that too, or if not, we'll do that in a subsequent interview. By the way, for your listeners, the live portion of the conference, that is, if you attend physically in Boca Raton, will sell out in the next month. We have unlimited ability to attend via live stream. I should also tell people that there is an absolute, irrevocable money back guarantee. If you think for any reason that you didn't get your money's worth out of the conference, whether or not you attend live or via live stream, we will, no questions asked, refund your tuition. I'm delighted to say, in terms of live stream last year, we sold 1,400 seats. We had 3 refund requests. So pretty clearly, we fulfilled the market's expectation. But the fact is, that it's a riskless transaction financially. If you don't think that we earned your money, we'll give you your money back.
Sounds like a great deal, and we will happily put that link in. And
Great.
I'm not exactly sure when our new website is going to be open, but we also will sponsor wherever I'm speaking. It'll be listed there because I love to do live events. That's really I do a live every week here. That's my favorite. Doing live is my favorite.
I think that's the first time I met you on the panel at the VRIC, where we were on a
Yes.
panel together live, which was fun. It was
Yes.
fun.
It was. Well, thank you so much. And I hope that you got as much out of this as I did. Again, I'm going to encourage you to listen to it multiple times. Write down any questions. We can have Rick back on again and maybe even answer questions live. We'll figure it out. But until next we meet, please be safe out there. Bye-bye.